Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Udr Inc. Annual Report. Udr Inc. is a multifaceted company that offers a range of services in the real estate industry. At its core, the company provides property management services, encompassing the buying, selling, development, and redevelopment of attractive properties in targeted U.S. markets. The company's portfolio includes apartment homes, with over 60,000 units owned or under ownership as of December 31, 2025. This extensive collection of properties allows UDR to cater to a diverse range of residents, providing them with high-quality living experiences. In addition to property management, the company also engages in development and redevelopment activities, further expanding its portfolio and enhancing its offerings. As a leading multifamily real estate investment trust, UDR has established itself as a reliable partner for investors seeking superior returns. With over 53 years of experience, the company has consistently delivered long-term value to shareholders while maintaining high standards of service for residents and associates alike. UDR Inc.'s stock price has experienced a decline of -7.65% over the past year due to a combination of challenging market conditions, conservative future guidance, and analyst downgrades. The company faced significant challenges in the form of declining blended rent spreads and occupancy rates. Weak consumer confidence, soft employment trends, and elevated new supply levels in certain markets contributed to these difficulties. The ongoing supply pressure and uncertain employment outlook led to tempered rent growth, with new lease rate growth remaining deeply negative. In February 2026, UDR issued conservative guidance for 2026, implying essentially flat growth or a modest year-over-year decline in FFOA per diluted share compared to 2025. This forward-looking guidance likely contributed to investor caution regarding future earnings stability. Additionally, the company announced its plan to be a net seller of apartment assets in 2026. Analyst downgrades and lowered price targets further exacerbated the decline in UDR's stock price. J.P. Morgan downgraded UDR to an underweight rating from neutral, while Truist Securities maintained a hold rating but lowered its price target for UDR. These actions reflect a more cautious sentiment from financial institutions regarding the company's near-term performance. UDR Inc. maintains a market capitalization of $14 billion, broadly in line with the industry peer group. UDR Inc. trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 3.85 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 59% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.52%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the apartment industry are multifaceted and influenced by various market, economic, and regulatory factors. Revenue growth is primarily driven by an increase in apartment homes owned and managed, development of new communities, and pre-development activities for future commencements. Higher gains from dispositions of real estate, higher total net operating income, NOI, and increased interest income also contribute to revenue growth. Additionally, market rental rates have been increasing, leading to higher revenues. However, revenue decline is often the result of unfavorable apartment market and economic conditions, competition from other apartment communities or alternative housing options, and failure to renew leases or relet apartment units as leases expire. Less favorable lease terms upon renewal or reletting also contribute to revenue decline. Inflationary pressures on operating expenses and interest rates further exacerbate revenue decline. Other factors that impact revenue growth or decline include changes in real estate tax laws affecting residential property tenants, compliance with environmental, housing, and employment-related laws, increased capital expenditures due to climate change regulations, litigation costs, and potential reputational damage from lawsuits. The net income of a company has undergone significant changes over the past few years. Initially, it increased from $84.8 million to $372.9 million, indicating a substantial growth of $288.1 million. This increase was primarily driven by higher gains from dispositions of real estate, higher total net operating income, NOI, and lower depreciation expense. Furthermore, in 2025 compared to 2024, the net income increased by $225 million due to a gain on sale of operating communities. The primary drivers for this increase were again higher gains from dispositions of real estate, interest income, and other income/expense. In terms of profit margins, it is implied that they have been higher due to increased net income and revenue growth. The same-store NOI growth was 2.3%, indicating a stable performance in this area. However, the operating margin remained relatively stable at 68.6% in 2025 compared to 2024. The AFFO, adjusted funds from operations, margin showed a slight decrease from 2.22% in 2025 to 2.19% in 2024, indicating a minor decline of -0.03%. Nevertheless, the AFFO margin increased by 0.02% from 2023 to 2024, suggesting an overall improvement in profit margins over time. The company is indeed generating positive operating cash flow. This can be confirmed through multiple sources within the extracted summaries. On page 8, it explicitly states positive operating cash flow. Yes, indicating a clear affirmation of the company's financial health in this regard. Furthermore, pages 51 and 55 provide numerical evidence to support this claim. The figures for operating cash flow in both 2024 $876.8 million and 2025 $902.9 million are positive, demonstrating a consistent trend of generating more than enough cash from operations to cover expenses. Additionally, page 57 directly states that the company is indeed producing positive operating cash flow, leaving no room for doubt. Even page 59 offers an explanation for this phenomenon, attributing it to significant gains on the sale of real estate owned and interest income. Overall, these multiple confirmations across various pages leave no question about the company's ability to generate positive operating cash flow. The company's debt level and interest expenses have undergone significant changes in recent years. The company's debt level has increased substantially, with long-term debt obligations rising from $5.835 billion to $7.087 billion. Additionally, notes payable to UDR as of December 31, 2025, stood at $1.7 billion, up from $1.4 billion in 2024. The company's secured and unsecured debt levels have also increased, with total secured debt reaching $961 million and total unsecured debt totaling $1.066 billion. In contrast to the significant increase in debt level, interest expenses have shown a moderate increase. Interest on debt obligations rose from $794,708 to $1.126 billion, while interest expense increased from -$69,933, 2024, to -$75,211, 2025. However, when expressed as a percentage of total interest expense, the increase is relatively small, with an increase of 0.46% in 2025 compared to 2024. Overall, the company's debt level has increased significantly, while interest expenses have also increased due to higher interest rates. Management at Udr Inc. is pleased with the company's financial performance in 2025, as evident from the revenue growth and increased net income compared to previous years. The significant rise in earnings per share, EPS, also indicates a strong financial position for the company. However, management notes that comprehensive income was lower in 2025, which may be a concern. Despite this, UDR's financial metrics such as funds from operations, FFO, adjusted FFO, AFFO, and debt-to-equity ratio suggest a stable capital structure. Management is likely focused on maintaining this stability while exploring opportunities for further growth. The company's ability to manage its debt and capital structure effectively will be crucial in achieving its long-term goals. Management's strategy appears to be centered around maintaining a strong financial foundation, which will enable the company to navigate any future challenges. By focusing on revenue growth, net income, and effective capital management, UDR is positioning itself for continued success in the real estate investment trust (REIT) market. The company has made several strategic acquisitions and divestitures to optimize its portfolio and achieve its business objectives. Acquisitions include the purchase of apartment communities outside of existing markets, which will help expand the company's presence and increase revenue. Additionally, 3 preferred equity investments totaling $72.6 million were acquired, giving the company ownership of 3 operating communities with 1,006 apartment homes. The company also made full repayment of 2 preferred equity investments and partial repayment of 1, resulting in a gain of $195 million. In terms of divestitures, the company has sold several properties to fund other activities such as purchasing new properties or development/redevelopment projects. Specifically, 4 operating communities were partially sold for a gain of $242.9 million, while 2 operating communities located in Brooklyn and Inglewood were sold for the same amount. 1 community in Arlington was also sold for a gain of $16.9 million. Overall, these acquisitions and divestitures demonstrate the company's commitment to strategic growth and optimization of its portfolio. The company's financial activities have been marked by several notable transactions. Firstly, the company has a history of paying dividends to its shareholders. This is evident from multiple references in the extracted summaries, where it is explicitly stated that the company has paid dividends on various occasions. In addition to dividend payments, the company has also engaged in share buybacks. Specifically, the company repurchased 3.3 million shares of its common stock under a share repurchase program at an average price of $36.12 per share for a total consideration of approximately $117.8 million. This indicates that the company is committed to returning value to its shareholders through both dividend payments and strategic share buybacks. Supply chain disruptions pose a threat to UDR's profitability. The potential for supply chain disruptions is a significant concern for UDR, as highlighted in various sections of the report. On page 16, it is noted that development and construction risks could impact profitability due to supply chain constraints, leading to increased costs or delayed occupancy dates. Furthermore, on page 17, several specific concerns related to supply chain disruptions are listed, including tariffs, changes in immigration laws, increased material and labor costs, and higher concessions for lease-up and lower rents than expected. These potential disruptions could have a substantial impact on UDR's operations, making it essential for the company to closely monitor and address these risks. By doing so, UDR can mitigate the effects of supply chain disruptions and maintain its profitability. That concludes the financial summary for Udr Inc. Feel free to comment below, and I will be happy to answer them when possible.